Welcome to Boring Money, Rich Life. I'm your host, Joy Hicks, and today we're going to talk about how to structure an investment portfolio. As I told you guys, my goal is to just learn about all of these different money topics so that way I can fuel my rich life. And if you're here, I feel like you're seeking to do the same. I think we all know we should be investing. Of course, you want to save for emergencies, but if you're looking to actually grow your money, we know we should be investing. But for me, I'm like, okay, that's great. But how do I actually structure my investment portfolio? Like, how do I actually put this together? Where should I put my money? What should I focus on? So prior to me like paying off my debt and buying my home and all of these things, I was watching another YouTuber named Jaspreet Singh. And so I really like the way that he kind of breaks things down. And as I consume his content, I'll bring it back to you guys so that way you can learn as well and we can be on this journey together because we're all trying to fuel our rich life. So I was watching a video of his, and I'm going to share kind of his recommendations on how you should structure your investment portfolio. Now, I'm not a financial advisor. It's really just a conversation starter. So let's get into it. He was kind of talking about how you should allocate your funds so that you're a little bit more diversified, right? Of course, investing is a risk, but this is just kind of like his tip on what he does. You can tweak it a little bit, of course, for yourself and what works for you, but this is just how he structures his portfolio. He was saying that he puts 80% of his money that he sets aside for investing into real estate and stocks. So, mind you, in my last video, I talked about how he shared when he gets paid and he receives money, he has his 75, 15, 10 kind of strategy. So that means that he's only going to spend a max 75% of what he receives. He'll invest 15% of what he receives, and then he'll save 10% of what he receives. So we're just talking about that 15% bucket of money, right? This is not like your whole paycheck. And then 18% of that, he'll put it into a more speculative type of investment. So that could still be stocks, that could still be real estate, but it's just something that's a little bit more risky. So, like in the first bucket of money, I would say that could be more like a mutual fund or an index fund, something that I guess is on the safer side of investing, or maybe you buy with a company that has been around for 100 years. So they're not going anywhere anytime soon, or they don't look like they're going anywhere. Make sure before you invest in something that you actually research the health of that company. But let's say you're investing in like a blue stock, which they've done well, since going public and things like that. They're still on a pretty good path you know, that's going to be more of your like safer type of investing. But the 18%, that could be in those more risky type of investments. So he was saying that could be in like cryptocurrency, right? I think crypto is kind of like the trendy thing that we don't really know where it's going to end up in the next 30 years, but people are buying into it. And just making sure that they do have some just in case it really takes off and it becomes like a more common form of trade. So it could be something like that. It could also be a startup. So in one of my earlier episodes, I shared with you guys that one of the things that I'm interested in seeing over the next 4 years is what happens with like space. I think it's just a very interesting topic. I'm someone who likes innovation and things like that. Even if I'm not the first to dabble in it, I still like to see what people are doing and what comes out of that. And then I shared with you guys that Jeff Bezos, he is actually developing his own space company and it's called Blue Origin. And so I think that might be a very interesting industry to kind of watch out for. So maybe that's something that you invest in. Again, it's very risky. We don't know what's going to happen. It might not even really take off in your lifetime. It could be in the next generation's lifetime, but it's something where you're like, okay, this could be pretty big. This could take off. I'm willing to have a little bit more risk. I'm willing to take a little bit of a bigger chance. So hopefully I get a bigger return. That's what you would allocate that 18% for. And then 2% of the money, he was saying he reserves that for real gold. So this is not like words to live by. This is just, again, to kind of start the conversation. This is for us to kind of be thinking how we want to allocate our own funds when we're investing. But again, I would say, as somebody who is starting off and you need money, right? You might want to clinch onto that money a little bit more. Maybe just adjust the numbers where you're investing way more into those more like solid companies and things like that. And then once you get to a point where you start to see your portfolio growing, you're starting to see the type of returns, then maybe you can adjust it and you can start taking on some more risk. You really don't have to. You could be a passive investor who only invests in like index funds and things like that. I mean, I think it is probably kind of risky to not diversify, but hey, you can definitely do that because like an S&P 500, it has multiple companies in there, right? So you are pretty diversified actually because you are investing in this one fund, but you have the way to still get access into these other companies. And of course, the S&P 500 is like $6,000. So there's other like funds that you could tap into, that align with the S&P 500 that are a little cheaper. Like VU is something that I'm interested in. So, yeah, I would just say this is a good start. So, let me know if that helps. And as always, what is a boring thing that you can do today to start fueling your rich life? Thank you for watching.